Hello, this is Steve Malone with Compass FX. Hope you're doing well today and you're getting some good trades. Let's take a quick look at the Euro Yen. The Euro Yen is following a classic pattern that's been around for a number of years, and I want to review this pattern because I've often been asked by traders if using the Synergy model, looking at the Heikin Ashi style average price bars, the price action channel, comparing it to the Traders Dynamic Index, if there's classic patterns that can be found within the chart. And today there is this classic pattern that's been around, like I said, a number of years. As a matter of fact, it's a pattern that almost was forgotten about. Believe it or not, it was found in the New York Library back in 1976. It was rediscovered type of pattern, and the Euro Yen is following that pattern right now. And it kind of dictates what I've been talking about for a number of years, that the market has a tendency to move in like steps of three and then makes a correction. This is referred to as the Elliott wave. The Elliott wave pattern is one where we make a move, slight correction, a move, again, slight correction, then another move with some following correction move. So in this case, we move down, correct, move down, correct, move down again. And then we start going into a corrective phase where we make a move in the opposite direction, come off of that, and make a move again. Make basically a two-phase correction after making a what they refer to as an impulse wave move in one direction. So based upon what we have here in the Euro Yen, I want to just follow the pattern here and find out where it's attempting to go using some Fibonacci levels along with this classic Elliott wave pattern. Now, you don't have to be an Elliott wave master to understand the principle of Elliott wave or the fundamental basis of the Elliott wave. Just realize this: the market has a tendency to move in steps of three. I often tell folks, look at it like a staircase. It's like a step down, flat, step down, flat, step down. And then sometimes the market goes the other way. Step up, flat, step up, flat, step up, flat. Well, most of the time with the Elliott wave, you make a three-step move in one direction followed by a corrective phase of about two steps. The market flattens out, and then we go into the setup for the next move. Not saying that the next move is going to follow right into another Elliott wave. It may come at a later time. So with this in mind, let's take a look at this a little bit more detail and compare it with the Traders Dynamic Index down below. So we have the 1, 2, 3 pushes down. And then this is going to be our corrective phase. And what most people like to do looking at a corrective phase or looking at a retracement or reversal phase is they just simply take a Fibonacci from the top to the bottom. And right now we find ourselves just now breaking about the 103 level. And you can see that this has made a significant move, breaking the 38.2. 38.2 is your standard profit-taking level. However, at this point, some institutions are looking at the market to continue to move up with bids sitting right in the 102.50 to 102.80 area if the market dips back down again. Some institutions are already stepping in at the 103 level, and they're looking for a push up to the 104.25 level, just shy of this. Now, one key thing to be looking for is as we push up beyond this high and onto this high, is does this stretch up and make a full push towards the 618? That would be a sizable push to that level. That would be an extreme correction. Extreme corrections, though, lead to 1, 2, 3 down patterns. So I have another trading strategy that I refer to as a 1, 2, 3 up or a 1, 2, 3 down pattern. Now, taking a look at the Traders Dynamic Index down below here, you can see that we had kind of a double bottom scenario right here, and now the market's trying to make a little push. A double bottom here, a little correction, it held, and then it made a strong move back up. And this is all from the daily perspective. I simply would go in here and draw a trend line across these lows, across those two lows right there. And you can see how from that low to that low you have this trend line. Now the market's getting a little bit stronger here based upon the Traders Dynamic Index. So if I go from that low again across here, you can see that we're getting a positive bias in sentiment. Also, taking a look from a low price to a low price and carrying it on through, and then doing the same thing here, low across these lows, you can see our bias again is getting positive, and the strong move up intraday, you may actually see higher lows. So if we have continual higher lows, we expect to move on up. Now let me give you a thought about something here. If I move this down to that point, which isn't really a significant point because this retracement wasn't necessarily a 38.2, and so you'd use this high up here instead of this one if you don't make a retracement back to a 38.2. So we can see that this move this is important here. The 786 comes in at 103.80. Now we're looking for the move to 104.25, 104.28 area. But this is significant here. If we do not break above this 786, we do not break above the 103.80 level, then look for a possible rollback over. Okay, now what's happening is at the 786 level, we're getting in the bottom of this little higher range area right here. And if the market cannot sustain a move beyond that, then we look for a pushback down the other way. Now, something I like to do from time to time in my live active trade room is I often tell folks just simply go from the last swing low to the last swing low to last swing high and run your fibs up to look for potential targets. You can see here that the 1618 level is at 104.02. And then we push up higher, that's going to get us into the 105 level. And then that's going to test that 618 level from the full move down. That 105 area is going to test that up in this area. So here's my thought. We have certain levels going up that we need to be aware of. Okay, we have the 103.80 level. We have the 104 psychological level, which was seen as a 1618 on the move from swing high to swing low. And then we have the 104.28, which is a 50% retracement from the October 31st high to the January 9th low. So at this point, as we make our move, my suggestion is if you're going long from around that 103 level, then consider a tight short, because again, this is a corrective phase, and in a corrective phase, you've got to be aware that sentiment will at some point turn and follow the overall direction. What I see here in the Traders Dynamic Index, not only do we have this positive sentiment rising, but if I take these away, what we have here is a situation of a potential double top. We are still widening out, but we could find ourselves with a double top scenario in the Traders Dynamic Index, and then eventual rollover as this gets up into this area back here, somewhere between that 103.80 and that 104.25 level. Well, folks, this is Dean Malone with Compass FX. I hope some of this information will help you out. Again, the Synergy model here is following the Elliott wave with 3 impulse waves to the downside, followed by 2 corrective waves to the upside, and this is our second corrective wave, and just calculating the potential target of where it could go to. If you do trade this long in a corrective wave, keep your stops fairly tight and be aware of the potential targets. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.